Hello, everybody. So it's a new month, and I want to talk about 3 stocks that I hope to add to in March in this new trading month. The first stock, a stock that I've covered before on Patreon, I did a few exclusive videos on this one. It's Nebius Group. So Nebius Group is actually a spin-off from Yandex. And if you don't know Yandex, it's because you may not be Russian, but Yandex was actually the big tech company of Russia. It was very successful, before the whole Ukraine situation. Actually, it was on the radars of a lot of investors, this Yandex stock. But what happened after 2022, they had a spin-off, and so they spin off the assets and the founder and the management team. They went on their separate ways, and they founded a company in Europe called Nebius, and they also brought some of their assets with them, some very big side businesses. I talk about that, but the most important thing is they brought some capital, but they especially brought a management team and a founder that is very well connected. And as proof of this connection is this $700 million investment led by NVIDIA that they got in December 2024. And of course, the speed at which this business is ramping, because this business right now is saying in March, their run rate right now is about 220 million in recurring revenue. And they're estimating that their run rate in December 2025 could be between 750 and $1 billion of recurring revenue for their AI data centers, most of them located in Europe. And so, as you know, I'm a revenue growth snob. I'm all about the revenue growth. And when I see these numbers, I salivate. I care about sales growth the most, and this is pretty darn insane. The run rate today is 220 million. If they move to 750 million to 1 billion by the end of December of a run rate revenue, that sounds like a guidance to me, but then it's also a very big guidance, because that would be between 350 and 450% sales growth by year end. They could grow their sales by 3 to 4 times by year end. And if you do a trailing 12-month revenue, they are explicitly guiding. Look at the call, Neil Darshi in the call. We said revenue for Nebius should be in the range of 500 million to 700 million for the year 2025 for a full year, and EBITDA flat. We're guiding an EBITDA to be flat with a break-even period perhaps in the later half of 2025. So that's like guidance. That's a hell of a guidance at 500 to 700 million in revenue for a full year 2025 and flat adjusted EBITDA right now. Trailing 12 months, the EBITDA is still slightly negative, but this company has a lot of cash. You can see they have almost $2.5 billion of cash. So let me just go through my evaluation to tell you how good this looks. This looks very good to me. I'm using 600 million as the midpoint between 500 and 700 million. And you may say, what's going on? Did I lose my bullishness? Because usually I always use the higher end. Well, in this case, the growth that we're guiding is so high. You're talking about hundreds of percents of growth. So in this case, I want to be conservative and use the middle point, which would be 408% of growth, revenue growth going forward. 408%. This is nuts. This is crazy. And I'm using EBITDA margin at 0%, at 0.01, just so that I can calculate a number on my spreadsheet. And we know the revenue, by the way, last year, a full year ended 2024, we know the revenue was 118 million. So you're talking about a company that's growing so fast. So if we input this in my spreadsheet at 408%, gross margin is 56%, EBITDA margin is flat. We're going to stop losing money. That's all I care about. What do I get? I get an enterprise value over gross profit over revenue growth of a 0.19 and a rule of 40 of 408. This is unheard of. This is crazy. This is because this company is predicted to grow like insanity. But EV over GP over RG is very cheap. It's among the cheapest. It's the top 20% cheapest. But there's a problem in my analysis here, which is I count their cash, towards them. So I use enterprise value and I remove the cash from the 7.6 billion market cap. I remove 2.5 billion in cash. So that's how I get to 5.24 billion in enterprise value. But I don't remove their assets. They own a lot of assets which they brought with them from Yandex. And what are some of these assets that they own? Well, the most important asset in there is called ClickHouse. ClickHouse is an analytical database for ML and Gen AI. And if you know anything about stocks like Palantir or stocks like Snowflake, you know that the valuation for these startups tend to be through the roof. Now, this is a private company that they own 28% off. And the key question is, what is the valuation? So the last VC round for ClickHouse valued ClickHouse at $2 billion in October 2021. We don't have a private valuation. We have no idea how much it could be worth. But if you read a lot about this stock and if you read the rumors, many people are saying this stock could be trading privately at around $5 billion today. It could be more than that for ClickHouse. So if it were to have a private valuation of $5 billion today, that would mean that 28% of that billion is $1.4 billion. And so I would need to remove that from my enterprise value. Now, that would drop your enterprise value over gross profit over revenue growth to something like a 0.16. But that's not it. They have over businesses. So Triple 10, that business, I don't think is worth too much money. They only had 1,000 people go through the EdTech for training. It's a boot camp. They sell boot camps for $5,000. They only have 1,000 graduates. That doesn't matter. AV Ride. Again, the valuation for these type of companies could be through the roof in the coming years. I think it's interesting that they have delivery robots. That's a little change from like the Tesla and the self-driving on the Waymo. But still, I don't really know what valuation I should assert to that. It's probably a money loser. But there's another business that is making money right now, which is Tokola, which is kind of an Amazon. It's kind of a Russian Amazon Web Services. Amazon Mechanical Turk. It's like a Russian Amazon Mechanical Turk that helps you annotate AI, and when I discuss with AI, Grok specifically, how much Tokola could be worth, the AI seems to believe that this business could be worth $500 million, and so that would give us an EV over GP over RG of a 0.15, maybe a 0.14. So I find this stock to be quite cheap, and it's a stock that I hope to add to in the coming month, especially when we peaked in mid-February at $48. Now it's $42 just because they missed a little bit on earnings. I think the long-term thesis, which for me is mostly all about revenue growth, is more than intact. It's really good, and I'm happy to own this stock. Moving on to stock number 2 that I'm going to be adding to heavily in March, and I already added to it quite a bit in February, and that stock is LifeMD. LifeMD is the mini HIMSS, and I think LifeMD's valuation is just too cheap to ignore. Yes, they're not nearly as big as HIMSS. Yes, they're a little differentiated from HIMSS, but the valuation at some point makes no sense. I've highlighted the second row here. That's a 0.022 valuation. This is the valuation of LifeMD without WorkSimpli, assuming that they have sold WorkSimpli. LifeMD to me is like a baby HIMSS that hasn't popped. Well, it's all relative. It hasn't popped. It has done actually really good performance. When I look at the past 5 years, that's up 700% over the past 5 years. But they accomplished that with absolutely insane volatility. You can see they almost reached $30 a share before plummeting back down to $2 to $3, going back down to $8. Now we're at 5, and so I'm adding to this stock. But if you look at the performance over a 5-year period, you're at almost 110% average annual return over the past 5 years. This is what happens with small caps. They are riskier, but in the case of LifeMD, I think the risk is slowly going away, and the market may be picking up on that. This is not financial advice. You understand that very well on this channel. This is just entertainment, but it's a risk I'm willing to take on my portfolio on LifeMD. It's a small cap. Enterprise value is $217 million, but you can see they have $193 million in trailing 12-month sales. That means the stock is trading at 1.1 times enterprise value over sales. That's very cheap for a stock in a hot sector, the sector of vertically integrated telehealth, the sector of telehealth that does not use insurance, and because they don't use insurance, they can move much faster. Although LifeMD uses pharmacy benefits, they don't use health insurance, but they use pharmacy benefits, which is another distinction. I think the business is largely de-risked. If you look, the revenue is way up, and if you look at just the telehealth component, It's growing in the 50% range, a little slower than HIMSS, but still growing very fast. The company as a whole is EBITDA profitable. The cash flows turned positive. This is now a positively profitable company, which means that we are not at risk, in my view at least, not at risk of losing money from operating the business. The bankruptcy risk is far from us. The telehealth gross margin is heading in the right direction. We're now at 89% gross margin, which is outstanding, and we're spending less and less on ads, and they're about flat now. The ads are a little flat. We're spending a little bit more because of GLP-1, but barely. When I look at these charts scream to me operating leverage is kicking in. That's what these charts scream to me, and they report earnings, pretty soon. So maybe you want to wait until the earnings, depending on your risk preference, maybe you want to wait until the earnings, because I could still be wrong. Like I said, it's a small cap. Small caps tend to move hard. But I think this is a company that is confusing Wall Street. This is why it's so cheap, 0.022 or 0.04 if you include WorkSimpli. This company is cheap because of WorkSimpli. Because of this business's history, they ended up owning this weird software as a service company that looks like a very, very, very small and very, very cheap DocuSign of sorts. The revenue is flat, 50 million. That's still quite impressive that you could make this much money with a PDF merge, a resume builder, and a document signing software, and a signing software, and a legal software. This is kind of one of these many PDF merge websites. It's pretty darn impressive to me that they could achieve 54 million revenues just like that. Anyways, the business is for sale. I'm not sure who they could find to buy this business. Probably some sort of, a family office or a hedge fund or somebody who just owns a business to harvest the money. But meanwhile, they don't do that. Meanwhile, it's 7 million of free cash flow. The business is not sold, but it's cash flowing 7 million that goes towards LifeMD and towards the growth of LifeMD. There's really two options for LifeMD with WorkSimpli. If you're trying to sell it, the CEO has mentioned multiple times they're trying to sell it. But if they don't sell it, we might have to wait for a few years for this business to be so small that it becomes meaningless in the revenue numbers. But right now, unfortunately, it's still a little chunk, but less and less as the LifeMD business grows, as the telehealth business grows. And I'll conclude with telehealth. Like I said, it's confusing Wall Street. WorkSimpli is growing. WorkSimpli is flat. So because WorkSimpli does not grow revenue, but LifeMD grows revenue very fast, Wall Street sees 29% revenue growth because they don't dig deep enough. But if you dig deep enough, LifeMD is growing much faster. It seems to me like LifeMD, the business itself, has a similar growth pattern to HIMSS or to Roman. Roman is private. Roman is the big competitor of HIMSS. Well, the big, quote unquote big. It's a smaller competitor, but still. But anyways, if you look at that, they're growing a little slower, for sure. They're growing slower. I'm not pretending they're growing 69% trailing 12 months like HIMSS. They're growing slower. They're growing at 53%. But they're still growing. They're not best in class like HIMSS, but they are 6 to 7 times cheaper than HIMSS, depending on how you look. And I think they have a compelling offer, and I think they do it differently from Ro and HIMSS. They don't compete head-to-head. They have a compelling offer to try to be the Netflix for doctors, the Netflix subscription for doctor. How do they work? Well, they work good. I think their offering works good for people who have health issues that are a little more advanced than what HIMSS treats, right? It's not about hair loss. It's not about ED. They can treat things like diabetes. They can treat things like recurring health issues, what HIMSS is trying to get into in the future. But what do? It's $39 a month for one doctor visit a month. I find that very compelling. You also have an offer, $99 a month for unlimited doctor visit. Think about that. And that includes specialties as well. They have a GLP-1 offering for $75 a month, which includes a weight loss pill, by the way. And they can also prescribe you a GLP-1. And if they do, they're going to try to work with your pharmacy benefits to try to get you qualified for pharmacy benefits. And the medication, of course, is prescribed online. That's the whole point. And they can work with your pharmacy provider at your job, etc. So slightly different positioning for HIMSS. They have launched also their own digital pharmacy, because why send the business away when you can keep it in-house and be vertically integrated? They're working with Quest and LabCorp, so that's a partnership. HIMSS is just ramping their own. HIMSS acquired Tribe, though. HIMSS wants to own the lab business. LifeMD doesn't do that. LifeMD just partner with Quest and LabCorp. Anyways, the business is slightly differentiated. I think they will be able to handle more complex cases right now than HIMSS. They can do things like imaging and specialist. HIMSS doesn't do that just yet. To me, this company is focusing on a different segment of the market, people who may have pharmacy benefits, people who may have high copay for a doctor visit who would just prefer to pay $49 a month, and people who need to see the doctor more often. They have primary care, they do the primary visit, but also they need a follow-up for refills, etc., etc. So they could handle what I call mid-level health issues like diabetes or pre-diabetes. I think this is something that LifeMD can handle, and I find the offer pretty compelling. But of course, what compels me the most is the price. LifeMD is trading where HIMSS once traded, where HIMSS once was. But even HIMSS, in my memory, I don't ever recall HIMSS getting as cheap at a 0.04. The cheapest it ever got was a 0.06. That's the cheapest he's ever got. So it's still cheaper than HIMSS. Pretty much love to add it to this one in March. And the last stock is still to this day the stock that I've received the best comment on the YouTube channel. I'm not putting my money into placentas, bro. That's the best comment. I don't know what to say. So you can understand why this stock is so cheap. This stock is the cheapest stock in the history of the channel. I'll get to that in a second. But apparently a lot of quote-unquote bros do not want to invest in placentas. And it's extremely unfortunate because the cost of goods sold is near zero. They just collect it from donation network. And then they turn it into a 4-year shelf stable Band-Aid. So they sell it by the size. It's a few $100 for each of those allografts. And it disrupts pork-based allografts. If you know anything about that thing, it disrupts, like oftentimes in wood care, they use products that are based on pork. Well, that disrupts that. So I don't get too deep in the field. It's a tiny position for me, but nonetheless, I think this stock is so cheap that it's on a risk-adjusted basis, I'm very bullish on this stock. The Nasdaq uplisting, they could be listed on the Nasdaq as early as the first half of 2025. They have a big risk. The big risk is that 2 of their products, 2 out of the 4, could be off the local coverage determination from Medicare, and we don't know yet. We have to wait a few months until we find out. But if it's confirmed that we're not on the LCD, this stock could drop a little further. But it's a risk that I'm willing to take, because if they're confirmed on the LCD, the stock, in my view, would pop. And I'm eagerly waiting for the news on the LCD. It's a risk I'm willing to take for 2 reasons. The stock is way too cheap. It's a 0.08. 008. Twice 0, so under or 0.01. So we'll get to that in a second. But another reason, of course, is the diabetic foot ulcers, which is an application that we're working on right now, and we're trying to get this indication added to the amnio wrap, right, to their Band-Aid. And don't look this up on Google. This is very ugly, and I would have no issue imagining someone who has one of those even paying out of pocket if it was not covered. And this could have some revolutionary impact on diabetic foot ulcers. Huge market, of course, diabetic foot ulcers in the US and in the world, because diabetes is a very common disease. It's an epidemic. Anyways, let's get back to the valuation. What is the valuation? 0.008. In the history of a channel, I've never seen that. But you don't need to use my metric, right? And Rule of 40 is a 90%. You don't need to use my metric to realize. So first of all, they get the products for free. Gross margin is 97%. The gross margin is as high as if they were earning royalties. They are predicted to grow by analysts 80% next 12 months. EBITDA margin is already there. It's already 10% EBITDA margin. The company is already cash flowing positively. Enterprise value is 190 million. 190 million enterprise value, and the trailing 12 months sells 302 million. This is a company that is trading at 0.62 times enterprise value over sales. That is dirt cheap. Like I said, the economics are incredible with margins that are similar to a royalty business. But it's not a royalty business. They sell a physical product. The margin is 97%. Cheapest price in the history of a channel. Yes, this is a high-risk stock. Yes, it's definitely speculative because we don't know what's going to happen with the LCD. So this is definitely, as always, not financial advice. But I like the risk-reward. If the LCD says it's off, the product the stock might still be okay because diabetic foot ulcers, I think this will be a hit. I just think this will be a hit because this is one of the leading issues for people with diabetes is the foot ulcers, and if this is the best quote-unquote bandage out there, if this is the one that works the best because it's got stem cells, because it's a placenta, then I could see this product being indicated for diabetic foot ulcers, and then it's game over because we are talking about something like 7 possible million patients, perhaps on a monthly basis. That's how big this could be. And lastly, I'll conclude with that placenta collection. This is a huge opportunity. I think this business could have a lot of tailwind in the stem cell world because if they get access to a lot of placentas, they can also do things with those stem cells. And I think there's going to be a lot of therapies that are approved with stem cells. So they are at the heart of a deep tech revolution in healthcare, which is the stem cell world. It's called BioStem. The company is called BioStem, and they're really at the root of a potentially revolutionary segment of health, which is still under research and heavily underappreciated. Like I said, I'm not putting my money into placentas, bro. Comments like that are indicative of the feeling of the world, which is just they throw them away. They throw placentas away in most places. And so I think this could be a huge opportunity. I'm happy to own BioStem. I'm looking to add to BioStem. Highest risk because it's a pink sheet, but I like this one very much. I like these numbers very much. So anyways, this was not financial advice, not investment advice, just entertainment. Hoping you were entertained. Please like, please subscribe. Follow me on X, follow me on Patreon. Thank you for watching and have a wonderful, wonderful day.